Warren Buffett says that smart investors lose money all the time. But do you know why? These 9 mistakes cost beginners everything. Imagine you're planting a tree. You want it to grow tall and strong, of course. But what if you kept digging it up, watering it too much, or plant it in bad soil? That's how a lot of new investors treat their money. Warren Buffett, obviously the greatest investor in history, says people don't fail because they're not smart. They fail because they make the same emotional, impulsive mistakes over and over again. Let me be blunt. I used to make these mistakes all the time, and I'm sure I still make many of these mistakes to this day. Back in the dot-com days, 25 years ago, I was chasing hot stocks. I thought I was a genius. I made 98.6% in my first year investing, and I thought, oh my God, I'm amazing. Spoiler alert, I wasn't. In this video, I'm going to walk you through 9 common investing mistakes that Buffett and his right-hand man, Charlie Munger, say that you must avoid if you want to actually build wealth, not just pretend you're doing it. A bull market will make everyone feel like a genius. But what we're trying to do is have no fluff, no hype, just discipline, logic, a whole lot of truth. And the biggest part to that is the discipline on the emotions. Guys, these videos are for everyone across the spectrum, whether you're beginner or advanced, because no matter where you are, the emotional part and the discipline always has to be worked on. I work on it constantly. As a beginner, I wish I'd worked on it from the very start. I thought it just took understanding the numbers. If you understood financials, you could be a great investor. Not the case at all. Now, mistake number 1. Trying to time the market. Buffett has said the only value of stock forecasters is to make fortune tellers look good. And he's right. Timing the market is a fool's game. Value investing isn't about predicting the next crash. It's about understanding that every investment is the present value of all the future cash flows you're going to receive. And crashes don't necessarily change the fundamentals of the business. They just change people's price for the business at that given moment. Now, trust me, I've sat there and not bought stocks before saying, you know what, if I don't buy this now, there might be a better time to buy in the future. And is that a part of timing the market? Yeah, a little bit. But I can also be a lot more patient because I have a lot of other businesses going on. I've got real estate. I've got businesses. I can afford to sit there and wait for better times. But if you want to build real wealth, especially if you're younger, you got to stop checking for the perfect dip and start focusing on whether the businesses you're buying are worth more than the price you're paying. Our goal as value investors is very simple. Pay this price, but get this value. If you don't think that's possible, I just want to challenge that a little bit. Whenever you buy anything, you're intrinsically saying, I'm getting more value from this than I'm paying for it, or at least the same amount. So all we're trying to do as value investors is determine what is that value and compare it to the going price in the market. Charlie Munger absolutely nailed it. The big money is not in the buying or selling, but in the waiting. When you finally bought, how you're going to make a lot of money is letting those fundamentals just keep building on themselves. We don't want to jump in and out of investments. We find value and we hold on. That's the big goal. Mistake number 2, getting attached to your purchase price. Guys, this happens both as a stock's going up and a stock's going down. And I hear this one all the time. I'll buy it when it drops back to 100. Well, what if it never does? Or I will sell it when I get back to even. Well, what if it never does? That's the question. That's anchoring, and it's emotional. As value investors, we want to focus on price versus value. You can buy a stock at 20 and it go to 100, and you can reanalyze it and say it's worth more than 100. As value investors, we need to focus on that difference. We care about what the stock is worth and then compare it to what the market is telling us they're going to sell it to us for. Buffett has said so many times before, the stock doesn't know or care that you personally own it. This is not about ego. It's about the math. If the intrinsic value is still higher than the price, what are you waiting for? Don't let your past mess with your future. Mistake number 3, unrealistic growth expectations, which is something I see a ton of, especially in booming stock markets. We all want 10 times returns. We all want to 10x our money. But let me ask you this. Does that align with how the real business is growing fundamentally? A pencil company earning $1 per share doesn't magically start earning $10 just because you want it to, or just because the price has gone up 10x. That's not investing. That's fantasy. And Buffett says the investor of today does not profit from yesterday's growth. And Charlie's classic line is, if it feels easy, you're probably doing it wrong. The truth is, we as value investors, we are okay seeking boring, steady, reliable growth. That's what compounds. But most importantly, it compounds very well because those companies aren't involved in the hype. They're not involved in the big run-up. They're the ones that are sitting there quietly. That's the big key to generating a lot of long-term wealth. Mistake number 4, investing with leverage. I'll say it like Buffett. If you're smart, you don't need it. If you're dumb, you shouldn't be using it. Now, leverage is gambling in disguise. It magnifies gains, but also magnifies and can explode losses. And when I talk about leverage, guys, I'm not talking about real estate. I'm talking about taking your brokerage account, borrowing on margin to buy more volatile stocks. That is something that is kind of a double-edged sword. Yes, it can make a lot of money, but if things go south quickly, which in overhyped markets that can happen very quickly, what happens? A prime example is look at NVIDIA in early 2025. This company started at $140 for the year. At one point got down to $92 just in April. That was 3 months later. It had fallen 40%. And then guess what? By mid-July, it hit an all-time high almost of $180, almost doubling. And guys, this is not a $1 billion or $100 million company. This was a $2 or $3 trillion company that hit $4 trillion in market cap. Guys, the fundamentals didn't fall in half, and the fundamentals didn't double in a matter of 7 months. But that's the market. In 2008, people weren't just losing stocks. They were losing everything. Why? Because they borrowed money they couldn't afford to lose. In the Great Depression, the reason why stocks fell 86% was everyone was buying on margin. And what happens then is when they were getting called those loans by the bank forced them to sell their stocks even faster. And that perpetuated a selling cycle. So our rule is simple. If you need to borrow to invest, you shouldn't be investing, period. Again, this applies to stocks completely. Mistake number 5, investing in things you don't understand. Guys, this is the third tenet of our principle-driven investing. If we don't understand it, we don't invest in it. This one should be obvious, but somehow it's just not. Buffett calls it jumping over 7-foot bars. Why not jump over a 1-foot bar? The market is going to misprice the 7-footers and the 1-footers. Wait for the 1-footers that make sense. If you don't understand how a company makes money, then you're not going to understand how it could lose money, and therefore you're speculating, not investing. This is something I've said time and time again. Guys, I don't buy biotech just because some person who's an expert in biotech says it's the next great company. If I can't understand it, I just avoid it. I don't understand banks or insurance companies. And I think because of that, there's a lot of opportunity there, but I haven't been able to learn enough about it. So for me, I avoid it. I want to be able to find companies that I could explain to a 12-year-old and say, this is what they do, this is how they make money. If I can't do that, I'm probably not going to touch it. That's the discipline that's needed. Mistake number 6, being too active. Guys, we all want to log into our portfolio, check it, how's it doing? And that's great when stocks are going up. But refreshing your portfolio 10 times a day doesn't make you a better investor. In fact, if you're a long-term investor, why would you even do that? It's just going to make you more emotional. Buffett said it best. The market is designed to transfer money from the active to the more patient, from the more impatient to the patient. The reason is patience is a superpower, and it's one that most people lack because they want to be in the action. Guys, I have the same issues. So what I do is I took up chess. I sell covered calls. I buy real estate. These are the things I do to keep myself active. You need to find something to keep yourself active and not checking your account. In fact, when I log into my brokerage account, I block it on my screen so I can't see my balances. And as of late, my balances, I'm sure, have been going up a lot. I don't want to get attached to the up, just like I don't want to attach myself to the downside. Set it, forget it. And if you buy good companies at good prices, over time, everything will work out well. Mistake number 7, jumping in and out of stocks. Guys, you wouldn't yank a plant out of the ground every week and expect it to grow, right? If your plant all of a sudden got a little brown on the leaves, would you say, oh, this thing is done, let me get rid of it? Of course not. Guys, companies are very dynamic. There's a lot of things going on. There's people in there working, doing things. Nothing is going to go perfect. You can't just sit there and sell because you heard some bad news that might be bad. Maybe so. But think about all the great companies we have today and all the bad news that's happened to them and the US and the world in the last 40 years. They've still done better. Buffett's rule, which I absolutely love, if you aren't willing to own a stock for 10 years, don't own it for 10 minutes. It doesn't mean you're going to own it for 10 years. But the key is, and this is what I love, the stocks that I own, I look at them and say, if the market for me to sell this company went away for 10 years, would I be happy opening it? If the market for this company went away, if the stock market went away for 10 years, would I be glad I owned it 10 years from now when the market reopened? And I can honestly say for all of my businesses, the answer is yes. And that's the key. This isn't a sprint, guys. This is a marathon. Great businesses take time to reward you. Why? Because as the business is getting better, the market is irrational. Let those businesses keep doing well, and eventually the market will take notice. Mistake number 8, which I think is a huge one right now, following the herd. This one absolutely kills investors. When everyone's shouting, buy this, buy that, you got to own this. How do you not own this? I do the opposite. Not necessarily I sit there and don't own it, but I would sit there and say, well, if everybody likes it, there's probably a reason why. And I look at the fundamentals and the pricing and I go, oh, more times than not, there's a disconnect. Because think about it. Logically speaking, the time to find the best value is when people don't want it. Less people are buying the stock, therefore the price is staying lower. Don't invest based on emotion or consensus. In fact, you got to do the opposite. You got to invest based on facts, logic, and value. If you believe that process, and if you have a good discipline and emotional temperament, you will do well in the long run. It might take a while for that value to come to fruition, but eventually it will. Buffett has always said, you're right because your facts are right, not because others agree with you. Now, this is a way of thinking, and this way of thinking has absolutely changed the way in which I operate. I've always been a numbers person, but when I first started to get serious about buying individual companies with a process-driven approach, I focused only on the numbers. And then I realized, wait a second, there's more to this. And as I got more and more advanced, it became more about understanding the emotional side. That's why early in this video, I sat there and said, this video is for everyone. Reminders for those who are advanced, or even telling the people who are advanced in the financials, there's more to it than this. And for the early newbies, guys, if you're new to investing, you are so fortunate to get started right now in this video. It's all about understanding the emotional sides. Why? Because when fear is out there, when everybody's bailing, when everyone's scared, those are the times you look back at history and you sit there and say, I wish I'd bought then. Popping up on the screen right now is this chart going back to 1950, the S&P. And these events that occurred are probably not even 1% of the worldwide bad things that happened. And yet look what happened along the way. Stocks just kept going up because the fundamentals got better, because the US economy and the world economy got better. So guys, I have a principle-driven approach to investing. If you want to understand that there's 5 tenets to it, and they're wonderful tenets. It's a good way of thinking and being, not just in stocks, but in any sort of investment you're doing, whether in your business, whether in another business, whether in real estate. It's important to understand these tenets. And these are the 5 tenets that I absolutely live and die by. So if you want to get our absolutely free PDF, click the link below. Within a minute, you'll have it sent to your email, absolutely free, no strings attached. Enjoy it, read it, understand it. Remind yourself on your little reminders app on your phone every 2 or 3 weeks to go reread them. It's about ingraining this in your head like I do every single day. Mistake number 9, mistakes of omission. What that means is not acting. This is a sneaky one because it's the opportunities you didn't take. Charlie Munger admitted some of Berkshire's biggest mistakes were the great businesses they did not buy when they had the chance. And I've been there time and time again. I once passed on an amazing REIT at a great price and it doubled. I missed it. Not because I made a bad choice, because I didn't make any choice. Now, this is a tough one because you got to balance, are you buying it for the right reasons or are you buying it because of hype? Are you buying it because of FOMO, fear of missing out? Buffett says when it rains gold, put the bucket out, not the thimble. When the math checks out and you understand the business, act. Now, guys, the issue with this last mistake is it's easy to say in hindsight because we all attach ourselves to a story, and the story might far outweigh the numbers involved, right? That's the hard part about investing. That's what makes investing an art. That's why it takes that emotional fortitude to be able to do well. But my question goes back to, if the numbers work, if the story works, why aren't you acting? Buffett and Munger didn't get rich because they were perfect. They got rich because they were disciplined, they were patient, and they avoided the big, dumb mistakes. Now, don't get me wrong. They've bought companies that went to zero. They bought banks that went to 80% write-downs. They have their mistakes. But when they were right, they let those runners run. They just let them go and go and go. And they'll always say, Munger has said many times before, apart from our top 3 to 5 decisions, the rest of our results have been pretty much mediocre. But ironically enough, by the way, they don't like leverage. They use leverage in their business. They use the money they get from their insurance premiums, called the float, to go invest in other businesses, and that's added to their returns significantly. You don't need to be able to predict the future. You just need to stop sabotaging your own future. We believe in this principle-driven approach to investing. And the first tenet we invest by is we're investors, not speculators. We believe in buying great businesses for less than they're worth, and we let them run. Guys, I was just in my office talking to my brother, and we were talking about, we go through a lot of life changes with money and thinking about what do we need it for. And we were talking about one of our favorite investors. That was somebody we know, and how he invests very different than us. My brother was saying, why is that? I said, well, he has a fund. He's trying to make a living. He's got to invest for really big returns. We have to invest just to equate the market. We'll make a killing just equaling the market. And if we can add a little bit of premium by being a little bit smarter when other people are panicking, then we will do very well. That means when markets are falling and stocks are becoming irrationally low, we put more in. That will make us a lot of money. Now, as you learn in this video, most investors jump into individual stocks with no idea what they're really worth. They follow tips, they chase trends, they chase stories, and they hope for the best. That's not investing. That's speculation. That's guessing. If you want to buy stocks the way Warren Buffett does, based on logic, not luck, you need to understand intrinsic value. Guys, the more logical and emotionally sound you are, the luckier you will be. It's an important skill for picking individual stocks. And in our next video, I'm going to break that skill down step by step. You're going to learn how to value a company the right way. I'm sure you've also looked at companies and go, what do these ticker prices mean? How do I value this? This is what we're trying to do here. You can find great businesses, avoid overpaying, and invest with real conviction by watching the video on your screen right now. I will show you exactly how it's done. Thank you for your time.